In this fifth and final video, we'll be dealing with partnership liquidation. So when a partnership decides to liquidate, which means end its business, it has to complete the accounting cycle, which means do all the closing journal entries so that only balance sheet accounts are open at the time of the liquidation. Then the partnership will sell all its non-cash assets, pay liabilities because creditors have to be paid first, and anything that's left over will be distributed amongst the partners. So there are 4 steps in the liquidation: selling non-cash assets and recognizing any gains or losses, allocating those gains or losses to the partners is the second step. Paying partnership liabilities out of cash is the third step. And then finally, distributing any remaining cash to partners based on their capital balances will be the fourth and final step. Let's look at an example to see how this works, as speaking about it in theory might be a little bit confusing, so it would probably be easier to see it in action. Going to your handout, I am looking at example 12 on the handout, Farley, Green, and Hall. So Farley, Green, and Hall are partners who share income and losses in a ratio of 5:3:2, which means that Farley gets 50%, Green gets 30%, and Hall gets 20%. On April 9, 2014, the partners decide to liquidate the partnership, so they decide to end the partnership. On this date, each partner has a capital balance of 22,000, so they all have equal balances. And the partnership has cash of 11,000, inventory of 30,000, equipment of 27,000, accounts receivable of 7,000, and accounts payable of 9,000. So what we see here is, as discussed in the opening, where I said that only balance sheet accounts are open because the closing journal entries would have to be made in preparation for the liquidation. So we get told that all non-cash assets are sold for 72,000. The reason we say non-cash assets is that you can't sell cash. So cash is 11,000, but any other asset that is not cash, so inventory, equipment, and accounts receivable, gets sold, and the amount that the company gets for those assets is 72,000. So we need to prepare the journal entries required for the partnership liquidation, and then prepare each partner's capital account showing all the relevant transactions. So let's go ahead and do the journal entries, after which we'll do our partner's capital accounts. So I'm opening up a new journal page, and we'll start with the first step. So step 1 in a liquidation is to sell off all non-cash assets. So an asset has a debit balance. When you sell or get rid of that asset, you are going to credit the asset. In the question, we are told that the partnership receives cash of 72,000 for the sale of all non-cash assets. So cash of the partnership will increase by 72,000 because that's what they got for selling their assets, and all their non-cash assets will be credited because, excuse the typo, because we are getting rid of these assets. So inventory is going to go down by the balance of 30,000. Equipment is going to go down by 27,000. We are selling because the partnership is liquidating, and accounts receivable will also go down, and it's going to go down by the balance, which is 7,000. So what we notice here is that the book value of all our assets was 64,000, but we actually received 72,000 for these assets, which means that we received more cash than what we were carrying these assets at in our books. So since we got more cash for them, we actually made a gain. The gain is going to be the difference, right? The gain is going to be the 72,000 of cash minus 64,000, which is the amount of all non-cash assets, and that gain is going to be 8,000. Now gain is almost like revenue. It goes up on the credit side. So this gain on sale we will record as an $8,000 credit. So the partners made some money when they sold their non-cash assets. So we will say to record sale at a gain. Now the question is, well, what happens to this gain? We can't just leave it there, right? Because the gain will have to be allocated to all the partners. So in the very next step, we go and remember we have steps 1 through 4. This is step 2. We allocate any gain or loss to the partners. A gain is a good thing for the partners. It will cause their partners' capital balances to increase. So we credit capital for the gain and we will debit the gain on sale account to get it down to 0. Now you may be wondering, well, why am I debiting the gain on sale account immediately after just crediting it? Well, here we recorded the fact that we made a gain, and over here we are getting rid of the gain by allocating it to the partners. Remember, at the end of the liquidation, we can't have any more accounts open. So this gain on sale account we have to actually get rid of. And the way we get rid of it is to give the amount to the partners. Now, again, the gain is a good thing, so it's going to increase each partner's capital account. And the way we calculate this is Farley gets 8,000 times 50%, and the reason I know that is that in the question we were told that the ratio is 5:3:2, which means 50%, 30%, and 20%. So 50% of 8,000 is going to be 4,000, and then green is getting 30%. So green, we are going to say 8,000 times 30%, and that is going to be 2,400. Oops. And finally we have Hall, who is going to get 8,000 times 20%, and that's going to be 1,600. So in the end, the allocation to the partners' capital accounts should add up to 8,000. So the debits and credits are equal, and this is to allocate the gain to partners, right? So the gain account is now also closed. In the third step, if you look at your handout or the textbook, you'll see that the partnership has to pay all liabilities, right, in cash. So since there's an accounts payable balance of 9,000, remember accounts payable is a liability, so it has a credit balance. When we pay off that amount, we are going to debit accounts payable with 9,000. So the balance is decreasing to 0. And how are we paying it? Well, we're paying it in cash, so cash goes down by 9,000 as well. So this is to record payment of liabilities. So again, decrease accounts payable because we're paying the balance off, and decrease cash because we are using cash to pay off the balance. Now the fourth step gets a little bit tricky because in this step we have to allocate the amount that is remaining in the cash account to each of the partners based on their capital accounts at that point. So it's a little bit difficult to figure out what those amounts are without maybe the use of T accounts. So what I've done over here is created a T account for each of the partners, and you can go ahead and do the same. And what I'll do now is put in each partner's beginning balance. If you remember from the question, it said that each partner has a beginning balance of 22,000. So conveniently, they all have the same beginning balance. And what we do now is post each transaction that affected capital to these accounts so that we can see what the balance of each partner's capital account is before we pay them out in the liquidation. So going back up here again, we see that in step 1, capital was not involved, so there's nothing to post to the partners' accounts. And then in step 2, we have these credits to capital. So we will have to credit each partner's account for his or her portion of the gain on sale. So let's go ahead and do that. So Farley gets his gain or her gain on sale of 4,000, and then we've got Green who has a gain on sale of 2,400, and finally we've got Hall, who has a gain on sale of 1,600. And so we can figure out now, based on that, we can calculate each partner's balance that they should be paid out. So it's 26,000 for Farley. It's going to be 24,400 for Green, and it is going to be 23,600 for Hall. So what we need to figure out now is whether we have the correct amount of cash to pay out each partner, because once we pay the partners out, the partner's capital balance will become zero and the cash account will become zero. You may recall from the question it said that there was a beginning balance in cash of 11,000. This is from the question. And then we also have all the cash from the sale, right? So we debited cash in the sale. Let's go back up so that I can show you. Cash debit 72,000, so that has to go into the cash account, and then we've also got this cash payment of 9,000. So let's go ahead and record the payment of 9,000, which gives us a balance here, a debit balance on cash of 74,000. Now what we are hoping is that these numbers in the partners capital accounts also add up to 74,000. So let's check. So it's 26,000 plus 24,400 plus 23,600, and they do indeed add up to 74,000. So basically what's going to happen now is that each partner will receive his or her ending balance, so that the partner's capital accounts can be zero. So we will have to debit each partner for their balance. So let's go ahead and do that in the fourth step. So what we have here is Farley being debited, meaning he's being paid out, so the balance goes down to zero. That's a debit of 26,000. Then we are going to have Green debit 24,400. Then we are going to have Hall debit 23,600, and as you may have guessed, the credit is to cash, meaning cash goes down. Remember, cash is an asset, so it goes down on the credit side. Cash goes down by 74,000, and this is to record distribution to partners. This is the liquidation distribution. So all we need to do now is include that journal entry in each partner's account and also in the cash account, right? So this is going to be, you could call it distribution, and it's going to be 26,000 for Farley, and therefore Farley's capital balance is going to be zero. And then you have a distribution again, and this is going to be 24,400 to Green, making Green's capital balance zero. And you have Hall having a distribution of 23,600, so Hall's capital balance is going to be zero. And finally, remember, cash was credited with 74,000, so we are going to do 74,000 credit, giving us a balance on cash of zero. Is this the result that we wanted? Absolutely. The reason being that at the end of a partnership liquidation, every account should be zero. We've zeroed out all the non-cash assets over here. We've zeroed out the gain on sale. We've zeroed out accounts payable, and finally we zeroed out the capital accounts as well as the cash account. So that concludes the demonstration of partnership liquidation journal entries as well as the T accounts, which I'll show you over here. So now you can go ahead and continue to work on your examples, and feel free to ask me any questions via discussion boards or in person.